All right, let's get now to the markets because you might have heard this. The S&P 500 continues to hit record highs. It's also on track for its best yearly performance all the way back since 1997. Joining us now is Simeon Hyman. He's head of investment strategy at ProShares. I mean, wow. Do you worry? We had the data a couple days ago that retail investors put $11 billion in the S&P 500 ETF on a Friday. It was the most in one day ever or something like that. Do you worry that all of our viewers right now are sort of piling in at just the wrong time?
Well, look, the December melt-up's not a surprise, driven by two things. Okay. The opposite of what we had last year. So we had losses last year, which were compounded, people taking tax losses, getting out. This year, you have people piling in. And by the way, it's the pros, too, because PMs want to put winners on their books, so they kind of look like they were there all year.
Hey, look, I own Apple.
I own it, right?
December 12th.
Yeah. And then, of course, is it any surprise that we're having dribbles of good trade news as the impeachment heats up? You kind of knew that was going to happen. So this is of no surprise. But if you compare, and everybody wants to compare the impeachments, and the things that are similar are late 90s, we had low inflation, low unemployment. What's different? Valuations this time around. In the end of 1998, we were at 28 times earnings with almost a 5% handle on the 10-year. This time around, we're at 21 times and only 2% on the 10-year. So at least valuations are a little bit more modest.
Well, 21 times forward earnings, Simeon, is nothing to sneeze at. That is still historically above average. But you're saying is, I guess, with interest rates and inflation where they are, we can handle the higher multiple.
We can. And if you're looking for bargains, or at least relative bargains, mid and small caps didn't quite melt up. They're at a 40% discount on a price-to-book basis, especially mid caps. Really, only that's on average of 10% historically.
1 year ago, we had an ugly, ugly sell-off. I remember that was off nearly 3%. The markets that day. It was terrible. Fast forward to a year later, what drove that sell-off a year ago was fears about the China trade war. Looks to be easing potentially. Concerns about the Fed raising interest rates. Kiss that goodbye as well, right? I mean, a lot of the big headwinds. Brexit appears to be sort of solved.
Brexit.
Yeah, and go back again to the comparison to the Clinton impeachment. We were overheating. We had over 4% GDP growth, and you don't hear a lot of people talk about this, but capacity utilization back then was almost at 83. 80 is that inflection point. We're only at 77. And then, of course, you had hikes in 99 because we were overheating. So modest growth, I don't want to call it Goldilocks, but there's certainly a lot less of that pressure of overheating because this recovery has been so muted.
Because we're not at maximum industrial capacity utilization, and we're also not seeing the inflation, and the wage figures are rising, but not nearly as much as we were seeing back then.
We all think that most people think that unemployment is not quite as low as we think because people will take better jobs and stop driving Ubers if they get a better offer.
What if we're in March or April or May and it looks like Elizabeth Warren or Bernie Sanders is going to get the nomination? How does that change your view?
No, for sure that's a risk. I think
what kind of risk? How significant?
Well, there are odds certainly coming up to the election that we'll see some more little fiscal surprises and things from the Trump administration. We expect that. But, there's a risk if we get somebody on the far left. I don't know how to quantify it.
Well, the odds are, if you look at predicted, it's 1/5. It's 20%. Not only will they win, one of them win the nomination, but they'll win the presidency.
But remember, they have to get those policies enacted. So some things we know from both the Obama and the Trump administrations, there's probably more latitude for the executive branch to do things than we kind of all thought 20 years ago, but there's still limitations.
What do you think about this? I had a dinner with some people in the markets, whatever, and I said, what's the real political risk of Elizabeth?
Right.
And they said it's not political. They said here's their concern with this proposed transactions tax. So much of the market is now high-frequency trading. You effectively kill those guys, right? Because now the tax renders their whole business unprofitable. No one's going to care because they're billionaires. They got plenty of money. No one feels sorry for them. But they're such a huge part of the volume and liquidity of the market now. There is a real concern that if that goes away, is the market structure able to handle that? And that's what I don't know. What do you think, Tom? This is your old world, man.
Yeah, I think it's stupid. I mean, I think it would be a tax.
That idea is stupid?
Yeah, it would be a tax on the entire economy. It'd be a wet blanket. No, I think a financial transaction tax would be a wet blanket on the entire economy. Spreads would widen. Cost of capital would increase. These are the sorts of things you will get from an Elizabeth Warren or Bernie Sanders presidency.
But even if you don't get them, the question is what the SEC can do, what different regulators can do. The amount of phone calls, I mean, even if you don't get legislation, There are real things you can do.
The limitations are there. You know,
I know there are limitations.
But what we know about markets is that the favorite thing that the markets have is gridlock. So to the extent there at least be probably a split between the House and the Senate, will be limitations on, you know, how aggressively right or left the executive branch could go.
Hey, Simeon, let me take you out to Silicon Valley. A lot of folks are talking about more IPOs in the first half of the year as people get concerned about recessions. IPOs weren't great this year, but what if there is a nice run of IPOs? What does that do? How does the market receive that, and how does that influence?
I think it'd be well received. I mean, if you're looking at tech valuations, they're not what they were, you know, back in the late 90s. And if you're looking at growth versus value, in fact, the relative price to book of growth over value has actually retreated to just below its long-term average. So there's certainly some room for some of that activity.
Would that not only help the new companies that may go public like Airbnb, but would it also come back and help the folks like Lyft and Uber and others who went public but have struggled as public companies?
Yes, but I think it's also almost paradoxically going to help old tech. We've seen some old tech, of course, like Microsoft's in the headlines, but you know, some of the tech dividend players who have lagged a little bit over the last year or so.
Who are you putting on that list?
You know, Microsoft, Oracle, some of the old school names, and Apple, by the way, which has increased its dividend for 6 years in a row. You know, those are some companies that are having some traction. And again, you think those valuations are stretched, but we're only at about 2.2 times relative book of growth over value. That was 4 in '99.
Shepard Smith here. Thanks for watching CNBC on YouTube.